My name is Frederik Rieger, the CEO of the Cardano Foundation, and you're watching Taking Stock.
Two minutes to go here into the close with the NASDAQ officially as is. The small caps, the Russell 2000, both of those major market indexes officially in correction territory. The market sell-off on this Friday, March 2nd, the S&P expected to close down pretty close to session lows, down 1.5%. Let's bring in the Einstein of Wall Street, the great Peter Tuchman here. It is also options expiration day. We got an S&P rebalance. A wild tape today. What do you see?
I saw massive volume coming in for the day. The rebalance was huge, actually. It was the largest we've seen in history. It was a $192 billion trade, but we had, from the floor's point of view, we had $10 billion for sale on balance the whole afternoon, which is, for us, it's a perfect trade because at 2 o'clock we posted out and we literally went straight down after that. So, I don't think it's capitulation because it's part of an option expiration and it's part of a rebalance, but it definitely feels like it's flushing out a lot of darkness. And my hope is that maybe we'll bounce off these levels. Maybe there's some kind of a technical bid in the market, but right now we're not seeing it. And to close on a Friday at the lows of the day, we're right off the lows of the day, and we were down 120, I think, at the low on the SPY. To close at the low of the day on a Friday, to gap down, on Monday could not bode well for the market.
Yeah, time will tell. This is the second day in a row the S&P 500 trading underneath that 200-day moving average for folks who cover the technicals. We got to leave it there. Thank you for kicking off the show on Rebalance Day, nonetheless. The great Einstein of Wall Street. Time for the bell. Did I miss the gavel? I might have missed the gavel. No, I don't think so. All right, I'm going to start talking here, Bobby, and they're going to hit the gavel behind me. There we go. Let's go. Woo. Now it's time for the weekend. All right, folks, you're watching Taking Stock. I'm your host, JD Durkin. Just had the iconic closing bell down here, finally bringing about a close to today's trading action on Wall Street. The S&P 500 notching its fourth consecutive weekly loss, trading underneath the 200-day moving average for the second consecutive day. The NASDAQ and the small caps both in correction territory, defined as a 10% drawdown off their recent highs. The Dow Jones Industrial Average not very far off from correction territory if it's not there already. The S&P down 1.5 on the day, the Dow down 1%, the NYSE Composite Index down 1.5, and the Russell 2000 down 2.2%. Gold and silver both down, volatility elevated. The 10-year Treasury yield reaching its highest level since July, and the dollar finishing the week 99.39, just under the psychological mark of 100. Let's bring in Alex Giuliano, Chief Investment Officer at Resonate Wealth Partners, for his take on today's tape. Come on in this way, my man. Thank you for being here. Nice to have you.
Great to be here, JD.
Unfortunately, I wore my red jacket, which means I brought nothing but red for the big board here at the stock exchange. But man, oh man, what a session today. Wow, we cleared $4 billion here for options expiration. What are you seeing in these markets? A lot of chop and volatility, especially on a day like today.
Yeah, well, in the midst of the events going on now, JD, this is an event that has a beginning, a middle, and an end, and we find ourselves really deep now, 3 weeks into the slushy middle of an event. If you're looking for a parallel back in 2022 with the war in Ukraine, you had another geopolitical spike where people weren't sure how long things were going to take. Oil spiked, there were inflation concerns, and then you found yourself now in a conflict 4 years later that's still going on. I think the challenge for investors is trying to navigate when a geopolitical shock happens and fear sets in, how to react in the moment. And I oftentimes want people to understand that in the moment that things are happening, markets can move faster than you may suspect, and if you're waiting for calm, the markets may have already moved. And so this is actually an opportunity for investors to reassess where they wanted to be in the first place, and should they be looking for opportunities going forward for the rest of the year.
I wonder the guidance you're giving your clients and the questions they're asking you with a specific focus on oil. We're down here right now. We got West Texas price just under 99. We got Brent crude up to 111. That's the highest watermark I've seen it hit all week, and it's been the highest it's been for some time. What are you telling clients about oil shock, what that means for inflation or prices at the pump, and how does that translate to equities?
Yeah, I think the most important thing to remember is this isn't the first oil shock that's happened, let alone in the last 5 years, let alone historically. And so, again, this is in the middle of an event. The market's looking for clarity. Oil's moving on every tweet that happens or notice that gets posted. And so instead of focusing necessarily on the intraday moves and policy, you should be asking yourself, is this a structural change to the economy, or is this an event that will have an ending? And that ending may come later than people expect, but the markets may adjust before that.
Yeah, this is a good news cycle to have your notifications set for Twitter or for Truth Social, especially given the president's posts on social media really do tend to move the markets. What are the top questions that your clients are coming into you and the firm with as they try and navigate how to become smarter investors on this backdrop of a lot of uncertainty still?
Yeah, I think people mostly focused on, are they positioned in the right way, right? So we find ourselves in a situation that over the last year, the S&P 500, even after today's decline, is still up nearly 15% from the same time point last year. And in the last year, people have dealt with tariffs, they've dealt with challenges to Fed independence, they've dealt with immigration protests, they've dealt with Doge, right? There's always a wall of worry to climb, and I think investors are asking themselves, even after the decline today, they've still up significantly over the last year, and do they want to continue to be positioned in the same way they have been? And for the outlook for the future, do they want to take advantage of this as more of an opportunity to level set to where they want to be, rather than focusing on changing what they've done in the past?
Markets climb a wall of worry. I love the phrase wall of worry. Before I let you go, what do you like? Defensive plays, dividend-paying stocks? I'm sure we're going to talk a lot more about ongoing rotation for retail investors, at least, more into consumer staples.
Yeah, so JD, you mentioned the rise in rates recently, and I think that's an opportunity for strong dividend-paying companies that have a well-capitalized dividend to take advantage of the opportunity that now that rates have gone up, those names have been hit because dividends aren't as valuable in that environment. This may be an opportunity if rates drift down and we get an outcome in this conflict faster than people expect, that they may be an opportunity. And you've had a decline in certain names that have run up quite a bit, that have declined significantly, especially the concerns around SaaS, that there may be opportunities there to dive into with the decline we've already had.
Yeah, the SaaS apocalypse may continue. We'll see what the rest of the month and beyond Q1 brings. Alex Giuliano, Chief Investment Officer, Resonate Wealth Partners. My man, thank you for being here. Great to have you.
Appreciate it, JD.
Scholar's going to grab your mic. Enjoy your weekend. Take good care. We'll talk to you soon. Bobby will go this way. We'll bring you the latest analyst calls here that hit the tape this morning. Barclays reiterating, hi everyone, what's going on? Thanks for being here. All right, Barclays reiterating Rivian as equal weight. They say it is bullish on the company's ongoing partnership with Uber. Shares of Rivian down almost 20% so far here in 2026. Oppenheimer, meanwhile, upgrading Freshpet to outperform, installing a new price target, $80 a share on the stock. They say it sees an attractive risk reward for the company, down 7% on the month, but still in positive territory, about 4% on the year. Finally, Mizuho upgrading Chipotle to outperform. Shares were up on the day, but are down more than 10% already in 2026. Bobby, I did my best to find a couple stocks in positive territory. We got to start with Chevron, of course. It's been the big winner in the Dow for the last month or so, one of the better performing stocks. HSBC upgrading Chevron to buy from hold. They say the stock is well positioned given lower exposure to the broader Middle East region than you get out of companies like ExxonMobil. Shares of CVX up 11% month to date and up 24% from the start of 2026. And Bobby, here, let's take a look at shares of Dell Technologies, up fractionally on the day, reaching a fresh 52-week high after U.S. prosecutors charged Supermicro employees with smuggling NVIDIA chips into China. An absolutely wild story. We saw Supermicro stock tank on the day, and it worked to the benefit of Dell. Shares are up more than 25% year to date. FinTech TV's lead anchor, Remy Blair, sat down with Youssef Al-Madrasi of Neoris Protocol to discuss what cybersecurity really looks like in 2026. Take a look.
Well, joining me live here at the New York Stock Exchange is Youssef Al-Madrasi, co-founder and chief business officer of Neoris Protocol. Youssef, great to have you here. Thank you so much for joining me.
Thank you for having me.
Well, cybersecurity used to be considered something that was purely defensive. So what does resilience actually look like in 2026?
Today, I would say that resilience is no longer a perimeter around your infrastructure, but should be continuous validation, quantum readiness, and business continuity above all. And that comes with, first and foremost, being able to trust continuously your infrastructure.
Yes, and when we think about enterprises and the challenges that they face in this day and age, what would you say to them are the top priorities that they should be focusing on?
I would say, first of all, they should decentralize their surface of risk in the sense they should leverage their infrastructure to protect them and not what is currently happening in most systems. Today in systems, you have what we call a single point of failure. That means if I'm an attacker, I attack one device and take over everything. That's no longer resilient and it's not working. This is why we see the costs of cyber increasing so much.
Yeah, and when we take a look at cybersecurity, the role that nation states play, we know that the White House just released its 3-page strategy. So give us your key takeaways from that.
My key takeaways is that we're going into what we call a post-quantum world. That means there's going to be quantum singularity event happening within next few years. Now, in my world, we like to joke and say that every day we're 6 months closer to that event. And once that's there, we will need to have everything running on post-quantum cryptography. And this is something that the White House strategy has emphasized on massively. And that includes everything from infrastructure to network to identities. Everything should be post-quantum.
And while I have you here, Yusuf, I do want to ask you about the role of artificial intelligence. Here on Wall Street, of course, we're paying attention to how AI affects all industries of the listed companies here. But give us your take on the role that artificial intelligence plays in cybersecurity.
Well, AI can be an ally and can be, again, a vector of massive threats. Today, you have what we call polymorphic threats that change through AI. That means that a threat changes continuously as it evolves in attacking scenarios. So, again, I will go back to what I said. We need to be able to trust our infrastructure through decentralization, quantum cryptography, and validate continuously integrity of devices, network systems, and health of the node.
And in this hyper-connected world, we know that there are many risks out there, but I do want to get your take on the risks that outages actually pose. So what can businesses do?
Businesses should, first of all, adopt a post-quantum framework in the sense, maybe start with protecting their identities, because identity is the root of every single risk in cyber. Then move into their communication systems, namely VPN, TLS, system-to-system communication, and finish with endpoints. But again, I can't emphasize on that enough. Trust should be the core, and you should be able to trust your infrastructure through trust consensus.
And finally, before I let you go, we have less than 60 seconds here. So finally, in terms of innovations when it comes to cybersecurity, what are you looking at and why?
What are we looking at? We're looking at how to solve what we call the single point of failure, which is inherited by every single system today. We're looking at doing that through blockchain and decentralization. Now, people use that technology simply for validating transactions. What we think it should be used for is to validate integrity and state of devices, hardware, firmware, software, digital processes, all data across its life cycle. So that's half of it. The other half is post-quantum cryptography. We believe, well, quantum is coming, just like meteors struck Earth back then and extinguished dinosaurs. If we're not ready for that, it's back to Stone Age. No one can afford that, really.
Well, Yusuf, we will have to leave it there as we are approaching the market open here at the New York Stock Exchange. So thank you so much for joining us.
Thank you for having me.
My pleasure.
Welcome back to the show. Oliver Friesen joins us now down here on the trading floor of the New York Stock Exchange. He is the CEO of Guardian Metal Resources right off the Bell podium. It's nice to have you here today. Thanks for joining us.
How you doing?
Doing great. Much better now that you're here. Give me a bit of an introduction first and foremost to not just your work at Guardian, but why today is such a big day for the company here at the big board.
It's the NYSE. It's the greatest market in the world. So super excited to be here. And we're trying to build 2 new tungsten mines in the US. So really critical time right now. And the company is driving forward. And now we have access to the, obviously, the US market. I think it should be a really exciting time going forward here.
What are some of the things you most hope you could do now as much more of a publicly facing firm that maybe you could not do before today's listing?
So before today, UK listed business. Great capital market scene there, but it's nothing like here in New York. And both of our assets are in Nevada. They're in the US. They matter for U.S. national security, so we had to be in the NYSE and make sure that retail institutional investors here could get access to our story.
I want to ask you about tungsten because I love introducing our viewers to potential new asset classes and things maybe they hadn't considered for their portfolio.
Sure.
Talk to me about the importance. What are the basics for someone just really learning about it for the first time?
So really unique physical properties. It's one of the most dense metals on the planet. It has the highest melting point. I wish I had a little tungsten cube for you because it would really weigh you down.
Wow.
But it's used in defense, so that's obviously really important right now for all the geopolitical tension right now in the world. Aerospace, defense, as I mentioned, automotive, drilling bits, oil and gas, chips, solar, wind, you name it. We need tungsten for it. And the U.S. hasn't mined any tungsten for over 10 years. And get this, 90% of total global mine supply comes from China, Russia, and North Korea. So our mission is really important. We need tungsten mines in the U.S., and Guardian's leading the charge.
Yeah, and I can see there being a national security argument
Big
as
time.
well for a lot of power players down in Washington saying, hey, we need a real U.S. operation, so
Absolutely.
I appreciate that.
Yeah.
It's not as easy as you and I walking out of Lower Manhattan and finding tungsten on the ground here.
No.
You got to go to specific locations.
Yeah.
The state of Nevada, crucial to your operations. Talk about what is out there and why geographically it's such an important spot for the company.
Well, number one, Nevada is the top-ranked mining jurisdiction in the entire world, so it's a place you can get done, you can mine. And both of these assets have been in production before, and the reason they shut down was China flooded the market with cheap tungsten in the past. So they've done it before on home soil in Nevada. The people in Nevada, they want mining, they understand how important it is for the state, and it's so important to be in the right geographic location because you need people who actually want you there and want you to build these things, and Nevada is the perfect place for that.
What most differentiates your Nevada projects from other assets around the world, and really the most important parts about it that you would want would-be or potential investors to know more about?
It's on home soil, right? You know, there's a lot of projects out there. They're not in the U.S. We position ourselves as, we believe, the leading U.S. tungsten exploration development company. We've received an award directly from the Department of War, from the DPA Title III office, to push our projects forward and get them moving. But I think the best place in the world to mine is here in the U.S. and more particular in Nevada. And that's why I think people listening should be interested in the business is mine in America, right? We can do this on home soil, and Guardian's leading the charge.
I got less than a minute left. I don't want to make this sound too much like a quarterly earnings call. You got lots of time in future quarters for that. Give me some sense of what now this allows the firm to do, what the rest of even 2026 looks like now that you've made this big step today.
So we've done a capital raise now, so we can move the projects forward even quicker. So we're going to go put that money to use. We're going to be drilling, we're going to be engineering, permitting in the state of Nevada. And our goal is to get these both in production before the end of 2028, before the current administration is over. And the money and obviously the access to capital here in the US and on the NYC allows us to push towards that goal.
Oliver Friesen, CEO of Guardian Metal Resources, on a big day down here on the trading floor of the big board. Congratulations, and thanks for being on the show. Nice to have you.
Thanks for having me. Appreciate
All right,
it.
a lot more Taking Stock on this Friday coming up after this. Welcome back to Taking Stock. Our next guest is Zach Broughton Glennon. He is the general partner at Gradient. He joins us via Zoom on this Friday edition of the show. Zach, it's nice to have you here. So I know the company has been focused on artificial intelligence well before the hype, well before the headlines. We're talking all the way back to 2017. Talk to me about what gave you rather early conviction back then.
Yeah, that's right. And JD, thanks for having me. We have been investing exclusively in AI since back in 2017. We were ex-engineers and data scientists ourselves, and we saw the frontier of the capabilities of the technology back in 2017. We actually announced and launched our fund just a month after the famous Attention is All You Need, or Transformer paper from Google. And we've been at it for this decade, investing in AI. And we really believe that the frontier of the research, which the category really was at that point in time, could be encapsulated into great businesses and really radically scale technology capabilities. So it's been an exciting 10 years.
I got to ask about your $220 million Fund 5. It is oversubscribed and is independent. What does that tell you about momentum, even over the course of just the last few years, Zach?
Yeah, Google was the best partner we could have hoped for in 2017, when many LPs would have considered this a niche category. And they were a great partner, but we always contemplated bringing on external investors. And a key premise for the original launch of our fund was to catalyze the AI ecosystem. And, I think that has been accomplished. I won't take credit for it ourselves entirely, but we have just seen an exponential growth in opportunities and in founders building in the space, and exponential growth in revenue for AI companies. And thereby, there's plenty of interest from LPs who saw our track record, our experience, and the network we've built, and wanted to come aboard. So it's really the perfect time for us to, actualize our independence, but Google remains a key partner and investor.
Zach, I want to get your perspective on the so-called SaaS apocalypse. We've watched so many software as a service stocks get absolutely throttled, now viewed as a direct threat to artificial intelligence. They say software is over. Seems like you have an argument it's maybe just repricing. What are you seeing for the software names?
Yeah, look, sometimes I'm happy that I don't have to trade on the public markets, where you have to predict whether a growth rate is going to grow by 5% or decline by 5% next year. We've been investing in the disruptors to incumbent software for 5 to 10 years. Since we launched our fund, we saw that AI native and AI capabilities embedded within software were going to be key to the future of software. But where we sit today, my personal opinion is that the SaaS apocalypse may have been a little bit overblown. It's just that, yes, people are pricing in a competitive threat for the 5-10 year horizon, where maybe before people were modeling out kind of continuous growth in some of the biggest software names.
Zach Broughton-Glennon, general partner at Gradient. Zach, thanks for being here to make the case. Enjoy your weekend. You're welcome back on the show anytime. Bobby, let's head for a walk this way. We're bringing the latest headlines in the world of fintech, crypto, and artificial intelligence as you head into your weekend. First up, the crypto majors kind of flat to the downside. Bitcoin trading right around 69,950. ETH down 0.5%. Solana down 0.3%. Next up, Circle CEO Jeremy Allaire warning AI agents could replace a, quote, huge percentage, in his words, of human jobs, especially white-collar roles, as companies race to cut costs and boost productivity in the era of AI. And finally, the White House rolling out a national AI framework, setting the stage for a contentious fight with Congress over regulation, the use of energy, and big tech oversight. We'll be back with a lot more Taking Stock after this quick break, live from the New York Stock Exchange. Welcome back to the show. Time now for a few headlines in the world of startups, raises, and rounds for your Friday afternoon. First up, Arizona's Attorney General, a wild story, escalating a multi-state crackdown on prediction markets, filing 20 criminal charges against Kalshi as a federal state showdown over whether the platforms are gambling or legit derivatives continues to heat up. Next up, Microsoft weighing legal action after OpenAI's $50 billion deal with Amazon, arguing it could violate a key contract that requires exclusive access to OpenAI models to run through Microsoft Azure. And finally, the U.S. Navy set to sign its largest ever robotics deal with startup Gecko Robotics, ordering AI-powered robots to build digital twins of warships and predict maintenance before problems strike. Money 2020's very own Scarlett Sieber is now back to explain, how fintech companies really make money. Take a look.
I'm Scarlett Sieber with Money 2020, and this is how fintech companies actually make money. Today, we're going to be breaking down Melio, the SMB bill pay and receivables platform that turns, "I'll cut you a check," into, "It's already handled." Melio's pitch is simple. Make paying and getting paid feel like sending a text. SMBs can pay vendors by ACH, by card, even when the vendor doesn't accept cards, or by check, while everything stays synced with their accounting, especially QuickBooks. Vendors don't even need to sign up to get paid. It's the admin work your bookkeeper hates, made painless. So how does Melio actually make money? Card payment fees when a business chooses to pay a bill by credit card, commonly around 3% to the payer. Premium delivery and rails fees such as expedited check delivery or real-time international payment options. Also international transfer fees for USD or local currency payouts. Embedded partner distribution economics through syndication with platforms and FIs. Think about Fiserv's Cashflow Central, Shopify's Bill Pay, etc., which expand volume and revenue reach. Let's do a momentum check here for a second. In June 25, Xero announced it would acquire Melio for $2.5 billion, citing that 80,000 SMB customers, 30+ billion in FY25 payout volume, and 153 million FY25 revenue. Those are some big numbers. The deal completed in October 25 with Melio CEO set to lead Xero's combined U.S. business. That's serious scale and serious validation of an AP/AR as revenue infrastructure player. So what exactly is Melio's moat? Distribution and simplicity, deep accounting integrations with QuickBooks, plus embedded partnerships with giants like Fiserv and Shopify mean Melio shows up where SMBs already live. And the pay by card, even if your vendor only takes checks trick, keeps cash flow flexibility sticky. It's workflow plus Rails, not one or the other. Melio monetizes organization, turns chaos into clean accounts payable, gives SMBs more ways to pay, take a fair fee when speed of cards makes sense, and scale through partners. That's not just fintech, that's small business sanity packaged up. So that's Melio for you. If you have any businesses that you want us to feature on how they actually make money, drop them in the comments and maybe we'll feature them. In the meantime, back over to you.
Welcome back to the show. Your final tale of the tape on this Friday. The Dow Jones Industrial Average down a full percent. The S&P down more than that. And the small caps, the hardest hit, down on this Friday, March 20th, more than 2%. Next week, lots of Fed speak on tap as the lockup period ends. Friday, consumer sentiment earnings from Chewy, Beyond Meat, BitGo, and much more. Thank you for watching today's and all week's editions of Taking Stock. Have a good weekend. We'll see you Monday.